Tobias!
Brian!
What's going on, man?
Not much. How you doing? Good to see you.
What episode are we on now?
Episode 6
of the Pig Podcast.
Pig Podcast. Platinum Investment Group.
Love it. Where we're aiming to increase your wealth.
Yeah. We want
our goal.
to elevate your wealth through real estate investment.
Damn Skippy. I love it. So good chats today. Talking about corpse and non-corpse.
Yes. Corpse versus non-corpse.
Don't change the channel. It may sound boring, but it's very, very important because I think a lot of people, I get asked this question probably weekly.
I was going to say, it's a hot topic. It might be one of the most asked things next to how do I get a mortgage to buy a rental property, right?
Yeah, it's true, right? I think, you know what, it's funny because I think most people end up saying, I need to incorporate on my first property, right?
Yeah.
Now, where do you think that comes from? Why do you think people are saying that?
I don't know. I think that the perception is if you have a company, you're a business. And you're going to save tax dollars.
Yeah.
I think that's the biggest perception because, who thinks of that?
Yeah.
Or I think it is that a necessity like, oh, I'm going to do something. I better have a business for this. So I should get a corporation.
Right. And I think it's one of those things that is corp, non-corp, good or bad. I think the answer is it depends, right? Because sometimes a corp is a good idea and sometimes it's not. But I think it can limit taxes.
Yes.
One thing I guess is structured.
I was going to say we should highlight all of this by talk to your accountant first.
Yes,
he will have the most definitive answer for your situation.
Thank you for the disclaimer.
Yeah,
I appreciate
disclaimer.
That. Yeah, because we are not the CGA.
Yeah. We're giving our opinion based on what we've done so far.
Thank you, sir.
Yes.
Well put. Yes. So again, speak to your accountant. However, in our experience,
yes.
Corp can save you money on taxes, right? So let's break it down. So let's say corps for flipping. You know what I mean? What do you think about corps for, if I'm going to flip houses, is it a good idea to have a corp?
I think yes. And then we can say, what does a corp do? It allows you to separate that income from your personal income.
Right.
And in a flip, you get a big influx of cash all at once in one tax year.
Yep.
You might make 50 grand. That might double your personal income. So now you're shot up into this higher tax bracket that your work wasn't banking on. So they haven't been deducting enough. And then you have to take money from your proceeds of your sale, where if your goal is to continue to do more flips, you can shelter that income in the company and roll it into your next project. And the you're taxed at an active business because there's an active business income and there's passive income,
which is the rental.
Which is rental or stocks or whatever you're investing in where you're not doing the work.
Right.
And so when you have an active business and you're actually doing the work, like when you have a business as a mortgage broker, you can have an active business corp.
Totally.
Or a contractor or whatever. That flipping is an active business. So that is under active business tax law, which is a much lower corp tax rate.
Oh yeah, I think because corporate tax is between, I think it's 17 to 20 cents on the dollar right now.
Yeah.
Whereas if big shot like Tobias making all the money in the world, right? But it's a massive savings, right? Like sometimes we forget what our biggest expenses in life are.
Totally.
But biggest expenses are taxes, and just to give you an example, you said if you were to flip a property personally, and let's say you made 100 grand, right? After all your expenses, costs, everything, you made 100,000. Let's say you made 60 grand a year as your salary.
Yeah.
50% of that 100,000 is taxable. So now what that means is that $50,000 goes on top of the 60. So now, like you said, tax isn't taken off. Now you just went from a $60,000 a year income to 110. So now you just went from probably paying 30 cents on the dollar to paying 45 cents on the dollar or 50 on everything that you make. So now you're paying $50,000 in income taxes.
Big chunk of money. Chunk of money to just come, out and pay.
Yeah.
At the end of the year. And
totally.
And oh my God, heaven forbid you sell in February and do something with that 100 grand you made. And then the government says, oh, hey, by the way, you owe us an extra 30,000 in tax. And they don't wait.
Yeah.
There's no waiting.
Yeah.
CRA doesn't wait.
Yeah, they've got good interest rates. They charge about 30% on 20-30% on late fees. I think one of the biggest things my accountants told me before too, and something to always consider, is that opening up corps are not meant for tax evasion.
No, yes.
Okay, and it may sound no, but the reality is, right, or I should say the probably better word is tax avoidance.
Yes.
Right? To just open up a corp to avoid taxes, the government will challenge you on it. I think the mandate and I think the idea and the spirit of a corporation is, like you said before, is an active business.
Yeah.
So I think it's always to keep into consideration, do I have an active business?
Yeah.
Right? And I think there are a couple things. How many? You have to have a certain amount of employees.
Yeah, you got to have 5 full-time employees if it's like a passive business to challenge and say we're actually active. So say we'll use Effort Trust because they're huge.
Yeah,
they do rental income is their main source of income, right?
Yeah,
for the most part. But they have 5 full-time employees, so they can say no, this is actually an active business.
I'm sure they probably have 20.
Yeah. They need those employees to make that run. That now becomes an active business. But if you have 4 rentals and you're managing it with your wife, that won't count as active business.
What about my daughter, my cousin, my nephew?
And they're all on payroll? And you somehow turn a profit?
Well, and you got to be careful of that because it's interesting. When the government imposes new tax law, it can completely fuck your tax strategy.
Yes.
Right? And we saw that with some things where they're really looking at income splitting now.
Yes.
Income splitting, the benefits getting reduced. People who have holding companies are now going to be capped at, say, $50,000 of passive income. That's a lot of passive income, right? Yeah. But still, for people like doctors who have holding corporations and we're buying real estate in that, now if you're capped at that means what they're going to do is tax it at your normal tax rate. So, you know what? A tax strategy is important to have with a long-term goal, but don't kid yourself. We live in a world where that can change. The government can make a decision, it can change. So it's always good, again, bring it back to the fundamentals of cash flow, making sure that you are buying with the right things in mind, because you can get absolutely screwed over by
and I think that too leads into don't wait for the perfect tax plan. Yeah. Just, you should move forward with your plan and don't delay based on the taxes. Yeah. And it's not going to be the difference between even, I should have had a corp. It's not going to save you $10 million. No. It'll be a savings if it makes sense. Like we'll say for me, for example, now 10 years of investing, I would have not realized any benefit taxation wise from having a corp.
Yeah.
And 10 years in.
And the reality is money. You would have paid more.
And I would have paid more.
Because I equate
accounting fees, minute books, the bookkeeping end of it.
I equate it to like a wedding. Like if you, not that I've had a lot of them. Anyways. But if you order a limo for a wedding, all of a sudden it's like 10 times more. Yeah. But if you order a limo for a Friday night, it's surprisingly cheap. Yes. Right? If you do income taxes for a corp, it is exceptional. And I'm sorry to my accountant friends. I love you dearly. But it is a lot more expensive. And I'm sure there's a lot more work to it, right? Yeah. But that's something to consider. If you have one rental property, to incorporate for one rental property. And I know that if you're like me and Tobias, you may have ambitions to buy 100 or 1,000, which is awesome. Yes. But I recommend buy it personally, get additional insurance, liability insurance, instead of getting $1 million, get 2, get 3, overcover yourself. That's another reason sometimes people open a corp, to have that layer of protection liability wise. But you can, for way cheaper than doing tax service every year for a corp, quadruple your liability. Totally. Yeah. Like to up your premium. Like if I remember I went from $1 million to $2 million or 2 to 3 on my liability, it was like an extra $100 a year. We went from 1 million liability to 5 million this year. Mm-hmm. And our total premium increase was about 15%. And that added a bunch of other coverages too. We're talking like $100, like you said. Yep. And we 5 times as much insurance. Yeah. So and you're covered. And like you're ironclad. Someone slips and falls, someone does everything. Totally. You've got more than enough insurance that you don't even need to worry. Yeah. Which is way cheaper. And I'll tell you something too, like you need to have, and not that you don't need to have impeccable accounting or services. You'll be more heavily scrutinized. Well, when you have a corp, there's no, like, you need to have your shit in order.
Yes.
You can't just be like, oh, here's a napkin from when me and Tobias had lunch and had sushi. Like, you need to be very meticulous with because a corporation is, I think there's almost like a higher level of due diligence with your numbers in there. So and that's why probably the additional cost.
I think so.
So one rental, corp or no corp, what would you say?
I would say no. Even 5 rentals, I would say no corp.
Yeah.
Like that would be my personal opinion.
Yeah.
We have like 10.
Yeah, and you don't have...
And I still say no corp. There's no benefit for me yet.
I agree. You know what?
You can always change. You can roll them in.
Yeah.
There's a little bit of cost.
So you have to pay. So if you go non-corp and you want to change to a corp, you have to pay, as of now, you'd have to pay the land transfer tax.
Yes.
On the, I want to say black book value, but like reasonable value.
Reasonable
right?
value, yeah. But you don't have to pay. You roll your capital gains costs or any of that stuff in because it is a transfer. But you
roll it in, or as of that date?
They have a special section.
Okay.
Where you don't pay your capital gains tax when you transfer from personal to your corp.
Cool. I didn't know that.
I checked with you. Yeah. So like cool. say we're gonna have to pay $20,000 tax.
Yep.
That gets funneled into the corp.
So then that tax liability is now in the corp.
Is in the corp. Yeah.
So really, what's the downside to starting out and not incorporating is
land transfer tax. That's the cost, basically. Yeah.
But I would also say the lenders that will finance Tobias versus the lenders that will finance Ontario Incorporated 1, 2, 3, 4, 5 are far more on the personal side. So when you're actually looking to get financing, I think you can get cheaper, easier access to money personally because more banks will do it than a corp. Well, as soon as you bring in a corp, there's an added layer of paper, an added PITA factor. That's pain in the ass for the banks and lenders. So
not something you dip in hummus.
That's an added.
Not something you dip in hummus.
Tasty mortgage.
Yeah, totally. And especially when you're getting started out, your first, second, third, that's the hardest time to scrape together all your down payment monies. You don't want to be paying these extra costs to have these things and your extra 1 or 2 points on your mortgage.
For real, no benefit. Yeah. For real, no, like, and again, I'm open to, interpretation on it.
If you feel differently and you have a strong case, let us know. Because we're curious. We're always I'd be happy to be wrong and be able to bring somebody good information later.
Yeah, totally. We're always about feedback and learning, right? So, but I have to agree because I incorporated, I do have properties in a corp and I do have ones not in a corp. There are, I will say, depending on your strategy, like for me, if you're going to open up a business inside of your own building, I see a good value in a corp.
Yep.
Right? Because then you separate the two entities between the business and the landlord.
Yes.
Right? And I see a good tax strategy and planning there. Again, talk to your accountant. But just for your 1, 2, 5, 7 properties that are held personally.
Yeah. Especially residential. Now, if you go to big building.
Good point.
There's that liability limitation is really something that I think a lot of accountants say, hey, you should think about this.
Well, and I think too, that's a great point. I think everything Tobias and I are talking about now is strictly residential, 1 to 7, 8, 9, 10 properties, no corp. Okay. Right.
Yeah.
When you start getting into the multi-unit, 6, 10 units, 15 units, 20 units, I see a good value in a corp for a couple reasons.
Yes.
One, it's easier to bring in partners.
Yes.
If me and you buy something, then you can have 50% shares. I can have 50% shares. We can offer other shares to a partner in a corp. It's a little bit easier to do than if it's held personally.
Yes.
But financing, bringing back to that, financing in a corp is way easier once you get to the 6, 8, 10, 15, 20 units.
Yes.
Way easier.
In one building.
Yes. Yeah. Thank you. Yeah. For a big multi-unit property.
For a big multi-unit property, that would be commercial financing where they look at the building specifically, not your personal file. That's,
Oh, I love that. Honestly, like I was joking around before. I don't care if you're like slinging garbage or slinging crack. You know what I mean? Like, well, maybe they care about that, but a little bit. But they don't care about your job per se. They don't care about your personal debts per se. They're looking 100% at the DSC, which is the debt service coverage. Right. So that's basically you take your net operating income and divide that over. I had to make notes because I forgot about it. Net operating income over your principal and interest payment. And they like to see that it's a minimum of 1 to 1.25.
Yeah.
But It is actually awesome because it's a pretty yes/no question as opposed to the rigmarole you got to go through on residential, right? So it's just
so we'd like a blood, hair, and financial sample from you, and then maybe we may need a urine sample later.
Totally. And that's after they cut off your finger and hold it for collateral, like just in case, right? Like it is like we talked about this. Tough. It is getting tough, right? But be resilient, be resourceful, because there are people out there that will give you money.
Yes, always, right? Yeah. And, you can always step into the B space if you get too big, too personal, right?
Totally. Yeah.
But I think ultimately it comes down to your situation. You want to look at the situation as a specific plan and involve your accountant, involve your lawyer,
your mortgage broker, and realtor.
Involve your realtor.
One other thing I did want to throw in here because for those of you guys, girls out there that are buying flips, just be aware, and we've seen it a couple times now, where the government is coming back and asking for you to pay HST on a flip. And you're like, what the fuck? It's not a new build. Like, why am I paying HST? The argument is Tobias buys a house for $500,000 and he sells it for $800,000 or $900,000 because he's such a good renovator and finds good deals. The argument is that because there's such a big increase, you substantially renovated or changed the majority of the property, therefore making it fall into the new build, new construction category. Under that sort of tax strategy, you have to pay HST. And now that is a lot. We had one client where it was a $1 million sale. That's $130,000 that you're not like, that could be in excess of your profit. So I'm just talk to your accountant, get a tax strategy before you buy. Okay, talk to your mortgage brokers, talk to your realtor, talk to your accountant, okay, before you buy, because you know what, you could buy, and I think you've probably seen this, you could buy the best freaking property in the world, undervalued, because you find it, but if you have a bad tax strategy and you screw it up somehow, it can be all your profit, a bunch of headache, and you'll never want to do it again.
And you don't want to do a flip and make $100 because you had to pay $100,000 tax. It'd be terrible.
So it's like, make sure you do your homework ahead of time. Talk to your accountant. If you need resources, talk to Tobias or I. We've got phenomenal accountants that we can refer you to that can help you with the tax strategy before you go into it. Right?
Exactly.
Cool. Well, this was fun. So
good one. I like it.
Any questions anybody has, please fire through if there's any other topics that you want to have. And as we always say, the deal of the century comes along
every day. You just have to have your eyes open.
Damn right. Thanks so much, guys. Make it a fabulous day.